Danielle, how are you? Good to see you.
Good to see you. I'm great.
Hey, it's been, sorry about that. Now I've got to wipe the sweat off my brow that
It's a lot of adrenaline. Just breathe in, breathe out.
It is, and it's funny. You do these types of events, and there's it's always something. And you happen to be the first person. Sorry, you had to be the guinea pig, if you will. So, because you're far from that, you just happen to be the first one on our schedule today. So it's good to see you again. And
okay.
A lot's changed since the last time we spoke, and we spoke several months ago. But obviously, the Fed's been on this warpath, and I've got a lot of questions that I've got to ask you, especially after watching some of your more recent interviews. But I guess we can start with the last FOMC meeting, and it seems like there was a lot of emphasis on the dot plot, and I actually need to stop and say that you are, you come from a Fed background. You worked at the Dallas Fed. You've authored, you authored a great book, Fed Up, which I haven't, honestly, I have not had a chance to read it yet, but I do have it. But you're also the CEO and chief strategist of Quill Intelligence. And with your background, you have a lot of insights, not only to the Fed, but what the Fed chairman is thinking, since you do know Jerome Powell. So looking at this last Fed meeting, what are your thoughts?
So Jay Powell has never had any respect for the dot plot. So the fact that he highlighted it to the extent that he did, it was definitely signaling. And it was ball-faced signaling. He was saying, pay attention to it. It is talking about where we are headed. And we're basically learning that is 5%.
Yeah.
Will they make it? We're going to find out. But he definitely changed his tune at that last FOMC meeting. It'll be interesting to see, 6 days outside of an election, this next FOMC meeting. It looks like the Wall Street Journal mole has dropped a little. Oh, it's just going to be 50 basis points in December. But 50 basis points is still double what we were used to before. And if you look back to 2018, December 2018, he dropped a bomb on the markets back then with that December FOMC of 2018. And it looks like they're just going to plow on through.
Well, as you said, the market's targeting 5%. Whether or not we get there is another question. But, when do you feel personally that the Fed will, stop raising rates? And I know it's a personal opinion, and you probably got to see a lot of data, and I know how closely you scrutinize the data that's coming in, but it seems like they're choking off demand, and when you're talking inflation's doing a lot of the dirty work at this point, and with mortgage rates above 7%, where do you see the Fed going from here?
I mean, actually, deflation is doing a lot of dirty work right now. I mean, we're seeing home prices fall at the same rate that they fell the month that Lehman went down right now. I mean, the wrecking ball, I call it compression. We write about this compressed cycle all the time at Quill. I've never seen anything this fast. I was schooled when I was inside the Fed about lag, and they drill monetary policy works through the economy with an 18 to 24 month lag. That lag time has been decimated. I mean, decimated. You've never seen monetary policy go to work in the economy as fast as what you're seeing right now. And he is destroying demand left and right.
That's wild. Why do you think that is? Because maybe, I always use the analogy, the rubber band analogy. You pull the market or the economy or whatever it is, you pull it too far, you're going to revert to the mean really quick. And is that an explanation of why maybe that lag time isn't there this time around?
Well, I mean, you have to think back to what we were talking about a year ago, right? And that's, where the hell is the Fed? Why are they still growing the balance sheet? Why are they still engaged in quantitative easing? Why are they still at the zero bound? Why? Right. I mean, that was just a year ago. They just started this in March, March. And, judging from the H8 that came out after yesterday's close, quantitative tightening is up and running and going. I mean, all the little conspiracy theorist people on my Twitter feed have vanished and gone away. The people who are like, they're not doing it. They're not doing QE. They're still doing QE. They're like really crickets right now. Crickets. Because quantitative, and if you go around the globe, like it's 750 billion a month that's being pulled out globally. But so how far do I think they'll go? How far do I think they'll get? I mean, it's not every day that you're like, oh, the yen was 152 a few hours ago. Now it's 147. I mean, shit's happening. I'm going to paraphrase. A lot is happening. And we're watching treasury liquidity dry up in real time. It's not normal to watch the benchmark 10-year treasury yield move 15, 20 basis points in a trading day. So the market is starting to tell, and the Treasury is getting involved. They're taking comments. They're talking about buying off the run Treasury securities, trying to fill some of that liquidity gap in with higher bill supply. That's coming because that's actually out for comment. So the Treasury is in the background. I think I'm going to quote a buddy of mine who I can't name, but I think Summers is coming. I think Yellen is out. I think we're going to have an appropriate person who understands markets running Treasury pretty quickly here. I mean, we're just a few days out from the election, so just give it a few days. So because you need Steve Mnuchin's, he's no choir boy, but he was the appropriate person at the time when QE blew up, even if he was by poolside in Cabo, chit-chatting with his buddies at the biggest bank saying, we've got a problem. But you cannot have a Janet Yellen in her position right now for what's to come. But you can have a Larry Summers, and I'm no big fan of his either.
Well, you just said what's to come. Now, obviously I follow you on Twitter, love your work, and we'll talk about all that, towards the end. And I actually want to highlight a few things, but on your Twitter account, I want to say it was a couple weeks back, you said, the Fed is engaging in their biggest policy error or something to that effect. Could you explain what you meant by that? Explain to us what you meant by that.
So that was actually a tweet that was attached to a graph of what house price, what your average house payment has become.
Right, and, like double in whatever.
Look, they created this monster. Yeah, they fed the speculation. The 2.75% mortgage rates, which seemed like a dog year ago, but the Fed created this puppy, and now they're trying to destroy it. And what breaks along the way, we're finding out in real time. And one of the most intelligent things I heard with Weinstein yesterday at a conference basically said there has never been as good of an opportunity as there is today to short high yield in the United States. Because talk about your rubber band analogy. Yeah. We've never seen a market stretched so taut and have there be no reaction. Yeah. Yet. So again, everybody talks about the Fed's going to break, what's the Fed going to break? The policy error was in housing, and that's real destruction. As soon as projects are completed, you're going to have multifamily inventory, what's in the pipeline right now, and they can't stop it. It's under construction, 900,000 units. The whole undersupply narrative is going to vanish. I mean, what's Lawrence Yun at the National Association of Realtors going to talk about? He's going to have to go get a shrink so that he can, stop talking about undersupply, because it's going away. And so, but it's going to be the result of a massive policy error, is my point.
Well, where does employment fall into all this? Because, obviously, not only yourself, but everybody I've talked to, they always say employment is that lagging indicator. But if everything's sped up and we're seeing, everything come forward a lot quicker, why hasn't employment done so? And is it going to, maybe it won't, maybe it will. What are your thoughts?
So I think what people are missing in the employment narrative is that there's a pattern to your typical layoff cycle. It usually starts at the bottom of the income ladder. Well, that's where people are still, look, the food stamp program had a 25% hike in October of 2021. It just got another 25% bump in October of 2022. So there is still massive stimulus money flowing through the economy, keeping the lowest paid worker out of the workforce.
Yeah.
But, Facebook's going to lay off 12,000. Snapchat, all of these layoffs are not figments of our imagination, but they come with golden parachutes. They come with severance. Why would they manifest in initial jobless claims, for God's sake? People are getting, when Snap announced its earnings that took the stock down, whatever it took the stock down, 27% in after hours trading yesterday. I don't know where it's trading today, but 155 billion of their 155 million of their $360 million loss was for severance. So these are all one-time. We're not seeing it though, because the money's flowing to the former employees. So you're not going to see that show up in unemployment. You're just not going to see it. You shouldn't yet. However, the state of Indiana, I promise I'm not going off on it. Maybe I am, but the state of Indiana has the highest concentration of manufacturing in the nation. 28% of Indiana's gross state product is manufacturing. It is the not in Illinois, not Michigan, not Kentucky, not South Carolina, even though South Carolina is up there as well. South Carolina and Indiana have consistently had, compared to the rest of the country, rising initial jobless claims. When you drill down to the state level, we've seen it week after week after week. And it's telling you that the equipment manufacturers, that machine tool, all of these indices are gapping down at record paces. The Philadelphia Fed 6-month outlook. This is the beginning of your manufacturing pipeline, right? This is the chemicals hub in New Jersey.
Yeah,
basically. That's why everybody pays such close attention to the Philly Fed. It's been around since 1968. It's got the longest history, but B, it's at the beginning of the manufacturing process. We've never seen a 6-month outlook where it is. Not in 1980, not in the great financial crisis, never. The data that came out yesterday is unprecedented. So the layoffs are coming, but I'm going back for a third time to your rubber band. It's going to be an unemployment rate shock.
That is okay. And it's interesting. I was just having a conversation with a dad who works for and has worked for a large, chip company, and he could retire, whenever he wants to. And he's like, I hear layoffs might be coming, and, pick me, because I'm going to get a great severance package, and I'm going to, and it's funny. I was just having that conversation last night with another fellow parent. Let me ask you this about kind of shifting away from employment, but asking about a soft landing, because soft landing is not obviously in anybody's view at this point in time. But in your professional view, in your opinion, is there any way that the Fed could engineer a soft-ish landing from here? Like, what could they do at this point? So it's not all doom and gloom. I want to ask you, is there something the Fed could really do, in your view, that could change what seems like an inevitable path lower in a weaker economy?
I mean, a massive pivot could reverse the wealth effect. Look, your top 5% of income earners are responsible for 23.4% of U.S. consumption.
Yeah.
So if you want to make them richer and keep consumption going, because a GOP-led House of Representatives ain't going to do it. So the stimulus money's gone. And that's something that so few people are factoring in to their 2023 narrative. It's that there's no more free money coming out of Washington, D.C. I mean, Biden's like, look, the deficit's going to come down. And I'm like, you bet your ass it's going to come down. But not the way you want it to. Yeah. But that's been a huge support for this economy, is what's flowed into people's checking accounts, directly deposited.
Yeah.
That's bye-bye. Adios. So for the Fed to engineer a soft-ish landing, they would have to do full-blown pivot right now. QE starting back up. We're taking rates back down to the zero bound. The stock market can go haywire, and we're going to reverse that 20, whatever it is, that hit to your portfolio. And by the way, we've never also seen $1 million plus home sales fall like they are right now. So wealthy people right now, they're feeling it in two places, and they don't like it.
Yeah, that is a great point. And you want to talk about like the the housing market. I mean, you're talking about the negative wealth effect, and which is so true. I mean, if I'm a homeowner and I've got a, couple $1 million home, but now it's not really worth a couple $1 million home. Maybe I won't buy that big $5,000 couch at Restoration Hardware anymore, So
look, the things that I'm hearing on the
Yeah.
ground, we've lost clients in the furniture industry who are like, thanks, we were prepared, we fired everybody, and now we can't afford your subscription anymore. Bye. So it's what's happening in the furniture industry is it's your canary.
Yeah.
Your Restoration Hardware CEO, he was the pioneer. He was the first several earnings seasons ago to come out and say, there's a problem here, people. And that's exactly what freight told you also in March of this year. And what's happening in freight is also one of your leading indicators, and it's a bloodbath. I mean, you've heard from some of the largest publicly traded firms saying, we're looking for Christmas because we can't find it. September is peak freight season. Wow. And they're like, we've never seen a holiday season like this where we don't have demand for freight.
Crazy.
So, I mean, yes, the Fed could engineer a softest landing. If you want to find a glass is half full, Jay Powell could have like a lobotomy tomorrow, pivot, start QE, and take interest rates negative. Yes.
And, give us another Fed put, right. But he's trying to break that narrative. And I want to ask you about that. But before I do, one of the great things about being here at Trader Summit for you, the viewer, I see there's some questions coming in for Danielle. We're going to sift through some of those towards the end. So keep them coming. If you have some good questions, bring them in. I'm going to start looking at those here in a few minutes. But, talking about Jay Powell trying to break the Fed put, can you explain to the trading community what you really mean by that? Because I don't think a lot of traders, especially the newer traders, the ones that have been blessed by Robinhood and the PPP loans and all the fun stimulus over the last few years, explain that concept to the trading community.
So Paul Volcker, who is Jay Powell's idol, his hero, his mentor, and people forget that Powell was Undersecretary of the Treasury in the 80s. He knew Volcker personally and really did admire him. But when Paul Volcker was head of the New York Fed, he didn't care about Wall Street. He was a wrecking ball every day of the week.
Yeah.
There was no Fed put then at all. And this is from the head of the New York Fed. And then he went on to be chair of the Fed in Washington, D.C., and took a huge pay cut to do that. And think about that. His wife had to go back to work. Paul Volcker's wife had to go back to work when he took the job in Washington, D.C. Flip side of the coin is Jay Powell's worth $150 million.
Yeah, I was going to say he doesn't have to do that, right?
He doesn't, but he also doesn't need the job.
Yeah.
So Paul Volcker went to serve his country. What if Jay Powell's serving his country? And in doing so, breaking the mindset of the Fed put. Powell's not an idiot. He can see in real time that home prices are falling. He can see that we've seen this biblical reversal in used car prices, down 10% year over year. He can see all this for himself. And I think because he was so burned by transitory and a staff that led him down a very, very dark, bad path with their modeling, you can make the case that he's also taking outside counsel. So he knows that the Fed is indeed destroying the inflationary impulse. He knows that the housing is going to come through with a lag. So if he knows all this, then why is he still as aggressively tightening as he is, unless he wants to seize the opportunity to initiate a new generation of traders and investors and let them know what the world looks like when the Fed makes monetary policy for the good of the US economy in the long term, as opposed to Fed making monetary policy in a reactionary fashion just to make sure investors don't lose any money. Because that's the world that 40 years of investing since Alan Greenspan came around, that's what traders and investors, that's why everybody talks about the pivot all the time, because that's the only thing we know. Modern day investors.
Right. And that goes, I mean, that really goes back into the 90s as well. I mean, I just remember I was always watching for the briefcase indicator, with Greenspan. I mean, we just, that's all we want to know, when the Fed's going to come save the day. But, unless Jay Powell changes that narrative, the Fed put is off, and hopefully you guys and gals at home have a better understanding of that. Now, Danielle, I was actually going to make a tinfoil hat to put on my head last night. I didn't have the opportunity. I ran out of time because I got home from my kids' sports too late. I didn't get a chance to do it, but I'm gonna tell everybody at home or in your home office, brace yourself for a second, because Danielle, I'm gonna ask her about something specific I heard. I think it was in a panel discussion, and you had talked about a civil war. Possible that you've heard it from people. I know you live in Texas. I live in Arizona. We live in gun-bearing, hip-wearing states, Wild West, if you will. I'm not one of those people that want to put on a tin hat necessarily, but I'm going to take us into a world that kind of looks where there is, we have like maybe factions of people that are trying to fight with the government, and there is a little somewhat civil war. But forget all that. I want to know how the markets respond to that, and your view of what the stock market looks like would be probably fairly easy to understand. But more importantly, what does the bond market look like, and what does the dollar really look like in an environment where there's a lot of infighting in the US? Because like I said, I'm not sure how much of a reality is. Everybody's going to have an opinion, but what if? We have to always play that card. What if? So what do you think?
Yeah, I mean, as far as what if goes, very briefly, I'm no longer concerned about Texas and Arizona. What I'm hearing is that the people on the left are arming up. And I mean, in order to fight a war, you have to have two sides, right? You can't just have like the people on the right with lots of guns in the basement. So, but the foundation is being laid, so to speak. And I certainly hope that we do not go there.
Here.
But you have to ask, really, you can't ask about the dollar in a tunnel. You can't ask about it in a vacuum. You have to figure, if something like this is happening in the United States, what's China doing to take advantage of, and their propaganda campaign is very much fueling this idea of civil war in America. They're covertly encouraging this, which is kind of fascinating, because I don't think they can afford to go take over Taiwan. But it'd be a hell of a lot easier if there was something going on domestically in the United States, because it'd be harder to, and that would be the one thing that would actually bring the country together, by the way, is a draft.
Sure.
Would be a hot war outside. But if it was to be just theoretically in a vacuum, you would think that the dollar would be harmed.
Yeah.
And you would think that foreigners would step back from treasury auctions.
Yeah. Okay. And it's interesting to think about. And I have to agree with you as a combat veteran myself. I know that politics don't matter when if it's us against them, some other, foreign entity, which, it's an interesting world we live in. I thought I'd ask you that because it did grab my attention when you had that discussion.
I mean, Neil Howe, who knows a lot more than I do, he's like, he's 50-50. He's like hot war outside the United States, civil war. It's a toss up, which is, I mean, it's astounding to even have these discussions. It is.
And I know questions are coming in, and I'm going to get to them here actually right after this last question. But since this event is kind of centered around Europe and energy and kind of what the energy picture is going to look like, into the winter, and it's going to be a tough winter for a lot of people around the world. I don't know how much work you do with other global markets, but if you have an opinion, that's great. But also here, just even in the Wall Street Journal or Bloomberg articles about bracing for high energy costs. What does that do to the inflationary narrative that we already have now, and how does it affect our economy into the winter based on your views? What do you think?
So especially if there's this unemployment rate shock. Because imagine that as being a different backdrop than where we are today. So, there's a big difference between a smaller paycheck or an inflation adjusted paycheck not keeping up with the cost of living versus no paycheck. But I'll share an anecdote. I'm on a little local community dashboard thing, and a little old lady came out on this University Park dashboard and said, my Atmos bill went from $45 to $245. Has anybody else seen this? Is this a typo? Because it's been a rather hot summer. It really will be as destructive as you can imagine if we have a cold winter in the United States. Because it's the inflation that you could have Wall Street going, yay, look at core CPI. It's coming down so fast. Woohoo, Jay Powell's going to pivot. But the headline inflation will be very impactful to the real economy. And we've already seen a pullback in discretionary spending where we are right now, without people's, in the Midwest or whatever, without these massive increases. Because I've seen it down here in Texas, because people's utility bills have already gone up because it's 100 degrees, whatever. That shock is already percolating through. My own mother called me, and she lives out on a ranch in the middle of nowhere, but it's been hot. And she's like, my utility bill, honey. And I'm like, Mom, I know. I believe it or not, I know. I just wanted you to know, honey. I'm like, I know, Mom, I know. But it will get real if it's cold.
It's interesting. I mean, I lived in the Dallas-Fort Worth area for 13 years, and I've been through those ice storms, and they are not fun by any stretch of the means. And I've got a couple of questions that have come in from our viewers. One of them comes in from Trey. He said, if the Fed pivots with inflation at 8%, if they should do that, where's inflation going to go? 20%? And what about the Fed credibility being able to fight inflation? What is going to happen to the bond market after that?
Yeah, I mean, obviously, Fed credibility would be shredded more. I mean, what's left of it to shred if the Fed was to pivot at this juncture? But again, we saw what happened with the Bank of England. So people, you can't ask the question in isolation, because if there's one thing that no central banker can do, it's blow up the global financial system. It's like a no-no. It doesn't look good on your resume afterwards. And there was a meltdown in the global financial system. You're just not going to get the same speaking gigs after you leave office. So that will stop Powell. I think it's the only thing that would stop Powell, is something that is systemic. Otherwise, I don't think that the Fed can pivot right now. And I don't think that they will. And every time there's a rip your head off rally in stocks, they're like, yay, we can go tighter. Move that target, move that terminal rate up.
Speaking of systemic, and this is a question would be from me. I know, everybody's kind of talking about, here's the auto industry. That's going to be an issue, with all these bad loans out there, and, everybody's overextended. I mean, I haven't seen so many, nice cars on the road ever in my lifetime. Ever. And people are very, very loud about it too. But that doesn't seem like something that could be real big risk, like a systematic risk to the market, or is it? Or is there going to be just a series of smaller risks that really just compound into one it's a whole big issue on our shoulders as a country? What are your thoughts there?
Well, I mean, again, we're entering a potential unemployment rate increase cycle with subprime and deep subprime, and prime not too far behind it, at the highest levels on record. That's our starting point. So, and people view their cars differently than they once. I mean, the car gets you from point A to point B. So again, that's why I talk about societal systemic risk. If you take away so much from people, when it becomes economically impairing. We've written about this extensively. It sounds nuts, but you could see it playing out. And the same lax lending standards that were extended to allow people to buy cars they couldn't afford. And then there was and by the way, you don't have to make your first 18 months of payments. That same those same lending standards were extended to consumer installment loans and credit cards. And we know that credit card debt is now north of $1 trillion. And we're seeing delinquencies rise there as well. Again, without the unemployment rate rising. And starting points matter a lot. So I can't emphasize enough how important it is that the Republicans are going to take over the House of Representatives, because where's the safety net going to be?
Yeah. Great question. Jay asked a question, and you might have, you kind of covered this a little bit, but he said, what causes Powell to pivot? Because it has to happen at some point. What will have to break for him to stop interest rate hikes in QT?
So, I mean, we've written about this a lot, and my best guess is that something does happen in high yield, and that you end up with this situation where you have a liquidity event in a high yield backed exchange traded fund, because that's instantaneous liquidity. Theoretically, it's an ETF, but if the underlying collateral, the bonds backing this ETF, aren't trading at all, then you have issues with redemptions. And that to me would be something that would be systemic, right? When they came roaring in March 23rd, 2020, what did they back? LQD, HYG. I mean, that was no coincidence. But what if one day you were to wake up and State Street or BlackRock or maybe a smaller exchange traded bond fund was to say, there's a gate up. Happened in the UK with their property funds, right?
Yeah.
There's a gate up and we're no longer taking redemptions.
Wow.
You asked.
All right. Well, this one comes from Alexander. He says, questions to Danielle from one of her Swedish fans. How will the central banks behave during the next recession, maybe the one that we're in? And why should we consider reading your book, Fed Up? Well,
read my book, Fed Up, because it's the best primer out there on monetary policy.
Boom.
Yeah, I mean, basically. Yeah, I mean, I stopped checking Amazon. My ego, Danielle's ego, stopped checking Amazon when I got more glowing comments than Bernanke. Then I'm like, okay, I'm done now. My work here is done. So I moved away, and I recorded it, with my own voice with pneumonia. So listen, if you can't read, if you don't have the time. So it's interesting because we've seen generations of central banks coordinating their efforts. And in the last press conference, which was your first question, Jay Powell, he was kind of saying, I get it, but we need to make monetary policy for the United States. And I'm like, pardon me? Christine Lagarde's on line one, leave her on hold. I mean, that wasn't how things worked. I mean, there was this cordiality, there was this coordination, and there has been for generations, between Draghi and Kuroda and Bernanke or Yellen. If that's, I mean, but don't remember, the swap lines are open. So he's trying to prevent anything systemic on a technical level by keeping these swap lines. And trust me, that I had a speech in Geneva last week. The Swiss know those lines are open.
Yeah. It's, I was listening to your interview with Dr. Lacey Hunt a few weeks ago. Mm-hmm. And he was talking about, since he doesn't follow M2 money supply now, he follows, what is it right off the top of my head?
Deposits, liabilities every Friday afternoon at 4:15. I mean, it's the first thing I have no life, but at 4:15 this afternoon, I will be the first person clicking on the H8 as opposed to yesterday's H4, because we're watching liquidity get drained from the system. This is M2, 80% of M2, give or take, because the Fed doesn't report it anymore. Line 36, because I got all these questions, line 36 of the H8, that shows you other deposits, liabilities, and it's a great gauge of liquidity or lack thereof.
That was a really, really useful piece of knowledge that I think that everybody should go back and listen to that interview. That was a wonderful interview that you had with Dr. Hunt. Speaking of which, there's something about that interview that caught my attention. just because it's something something that I believe as well, that you know, if the Fed raises rates, you know, a lot of traders believe that the Fed's automatically going to just lower rates. They're going to bring it up to 5% so they have some ammo in the tank, and they can cut rates aggressively if there's any type of shock. Sure, but do they really have to lower rates is my question to you, because I think of it, and I don't think of this in a morbid way, but like imagine like you're somebody trying to choke off something. You don't like choke somebody and then let go, because then they can breathe again, right? You choke them and you just keep them choked. It's kind of the way I would think about that. If the Fed's
You've been watching like mafia movies late at night?
Yeah, you know, maybe a little bit too much of that.
No, so Dr. Hunt, and I defer to him, right? He started the Dallas Fed in 1969, before I was born. I can't say before I was born about many people anymore. Anyways, in his view, because the longest time the Fed has ever held rates at a high level was during the Greenspan era. But that was when there were 17, 25 basis point hikes in a row. And the market was like, oh, they raised interest rates again. Who cares? Because he broadcast it. He'd already told the market what he was going to do. But in that case, it culminated with the great financial crisis, because eventually the lag came through. That was a very long lag. But Dr. Hunt, and I defer to him, is of the opinion that it's literally impossible to do what Patrick Harker said that took the market down yesterday. You know, we're going to keep them there. Well, let me put it differently. It's never been done. So this would be, it would be different this time if they could do what they're talking about doing now. And here Lacey agrees with me. What if they're getting this terminal rate up to 5% in order to establish a new floor of 2%? Because 0%, you know, induced all this speculation time after time after time. What if Jay Powell's going to rewrite history and raise the floor? I mean, that's a possibility. And I mean, I will take my hat off to him if he accomplishes that. And you can do that if you've got enough runway, which could be one of the reasons, you know, he also wants to get that terminal rate up to that 5%, to have 300 whole basis points of easing, but raise the floor.
Do you think do you think he'd be able to stick around that long to see that through? Right? That'd be the question.
Well, I mean, he's got 3 years. Sure.
So you think you could do that in 3 years? Boy, that would be that. I guess that's funny.
Blake, I'm gonna flip the tables and ask you, do you think the Fed can keep interest rates? Let's say they get to 5%. Do you think we can keep them there for 3 years?
Yeah, with the S&P down at 2,500, perhaps.
Okay.
Yeah, right.
That would break the Fed foot, wouldn't it?
I just answered that question. So it's an interesting topic, and I actually. Danielle, I think that's really great insight. And speaking of great insight, I know we only have a few minutes left with you, and I just want to thank you so much for spending your time answering not just my questions, but those from the audience. Sorry about that. That's automatic. It just automatically happens over here. But I wanted to ask you, you know, as a trader, and the Trader Summit community is just a bunch of traders. We follow people's work. We get educated. We spend money on subscriptions to what we really like. So we have a good thesis of what we're doing. Tell us about Quill Intelligence, what you do over there, and how you can benefit the traders and their thesis on how they're approaching the market.
Well, I mean, we publish 8 times a week, and we publish, you know, the word is actionable. So we publish actionable investment ideas. June of 2021, that's when we said that the yield curve was going to flatten. March of this year is when we said, you know, short the auto sector, and short it across the board. Manufacturers, this is pre-Carvana. So, but we tell you what to do. And a lot of credit funds appreciate us, but these days the market is geared towards, you know, something that the Wall Street Journal Mole publishes or Fed speak. So stock market, you know, stock traders also greatly benefit from the research that we produce. Again, 8 times a week. Absolutely. And, you know, I just want to say one of somebody I've known for many years who's
who's we had acquaintances for many years, actually works for Danielle now, and his name's Andrew. And I know that at the end of the Traders Summit, we'll have a special for all of our viewers here, for people that came in specifically to see you, Danielle. Before I let you go, though, I just wanted to ask, are there any last minute thoughts or ideas you wanted to get out there and make sure that people hear something from you specifically that you want to warn them, or something to keep a lookout on?
I think even if you're a trader, I think you should put politics on your radar for the next few months here, because we are going to see a major change with the midterm elections. And, next time we talk, we could be talking about the debt ceiling next time we talk. So put Washington, put the Beltway on your radar, even if you're in and out of the markets constantly. Just pay attention to what's happening with the change of power coming in Washington, D.C. It's relevant to the day-to-day markets.
Absolutely, 100%. And by the way, Andrew is in the chat, and he's actually putting his email in there. So if any of you have any questions, you have questions about Quill Intelligence and what Danielle and her team does over there, make sure you reach out to him. He's also a friend of mine as well. Danielle, I want to thank you so much for spending such valuable time, especially on a Friday, in this crazy central bank wrapped around environment, dealing with the BOJ today, for crying out loud. Thank you so much for spending your valuable time with us and our community.
I appreciate your time as well. Take care. Enjoy the summit.
Thank you. Take care. Great having Danielle here. Steve, how was that?
Great. Absolutely great. Mrs. DiMartino is still with us. So can I steal another 45 seconds of your time, Mrs. DiMartino?
Of course.
Perfect. We have a question that involves, it's quite a complex one, but involves debt issues as well. And since we didn't touch the debt issue, but on the other hand, we have a very changing situation. The US was actually borrowing money at almost zero rates until very recently, and now it has to roll over its debt at quadruple those rates. How does that play out with the debt having exploded from 10 trillion to 31 trillion in like 12 years?
So that actually compounds my closing thought about paying attention to politics, because let's just say the world melts down. Republicans bend just as quickly as Democrats if their constituents are screaming for money. But if the US economy, if interest expenses for the economy, if the Fed keeps interest rates at a high level, that's going to impair Congress's ability to pass future legislation, because they're going to have to be paying so much out in interest that they'll have to pick and choose, which we can't even imagine, how they spend their money. Because we've had zero interest rates for so long, we haven't had to enter them into our fiscal calculus, into our thinking, but that is happening. Remember, the Bank of England, the country of England extended out the gilt maturity and took the opportunity of ultra low interest rates. We should have a 50-year bond. We should have a 100-year treasury. We don't.
Like the Austrians that borrowed for 100 years at 1% rate just a few years ago.
The Argentinians, for God's sake, as well. We didn't take that opportunity, and that means that we are beholden to very short rates in terms of refinancing, rolling over this debt. That is going to be very, very economically impactful in the coming years, and Jay Powell is going to be under tremendous pressure to bring interest rates back down in order to refinance national debt.
So coming back to Chase's question and attaching it to what you just said, and so we can wrap it up, do you think that they actually stay the course, or that they push and persuade central banks to, in essence, nullify the 2% inflation target, and we suddenly find ourselves for at least a prolonged period of time with a much, much higher inflation, so they don't have to cut spending globally? I mean, not only in the US.
You would have to fire Jay Powell for cause.
Okay.
For something like that, and that's very difficult to do. It's never been done.
Okay, so you think he will stay the course?
I think Jay Powell is going to stay the course. People forget he's a Republican.
Okay, perfect.
So he's naturally fiscally conservative.
Okay, perfect. Thank you very much.
You're very welcome.
Have a wonderful day.
Thank you so much once again.
Ciao.
All right.
Ciao, ciao.